What's up traders, Tom here with another video. Today we'll be talking about the stock market. More importantly, why is the market going up before the open and going down after the open? Let's just say history is showing us something ominous. Stay tuned. So before we get into the main topic of the video today, I want to bring up a cautionary tale, and that is Moderna, the stock that had the vaccine that was going to fix everything. Unfortunately, many people get carried away in hype, and this particular stock is not doing well after the initial hype and indeed the ramp up into the hype and speculation. And this is what happens when investors first get into the market. They often get caught up in the FOMO. And on this channel, we have a policy, no FOMO, always a plan. So Moderna, what's happening? Well, it turns out insider transactions are happening. Even the people high up in the company don't believe in the hype. They are selling, and they are selling in decent quantities. So it shows that when the price is good, the profit taking is best. And who would know better whether the company is fairly valued or not than these guys? So pretty large selling, all happening at the time of the massive amount of FOMO. So there's the story of Moderna. So you might be asking, well, who's buying this? Well, I think the Robinhood Top 100 Most Popular will show us the way. Here it is in the top 100 with 198,590 people buying this stock. And unfortunately, I'm sure many of them are going to be left with a stock with a massive red next to it. And that's unfortunate, but it's a lesson that everyone learns. It's been in lithium the last couple of years, Bitcoin at 20,000, marijuana stocks. What's the next one? There'll always be a next one. And usually most traders or most investors will have a few of these stories, but this seems to be the most recent one. So I'd just like to remind everybody before we get into the full body of this video, if you've been enjoying our videos, make sure to subscribe, hit that bell, give this video a massive thumbs up, and think about joining our free public Discord trading community. The links are down below, and I recommend that you get involved and start sharing your ideas with the rest of the community. So Europe's unveiled a $750 billion recovery fund. They've called it Europe's moment here. I think it's pretty common that or pretty well known that they were going to do this. And no surprises here. It's a pretty big policy. Obviously, it has buoyed the markets and the markets are up. But we'll see how long it holds, because it looks like there's some pretty bad news out of several places in Europe. One of those being the UK. UK now is covering 8.4 million workers. And I know that's less than, of course, America, but is a portion of their population. A lot of people are on the government wage subsidy schemes. In Australia, there seems to be a decent amount as well, but UK has quite a lot of people, and that number is increasing. So it looks like claims for subsidies filed by employers rose to 15 billion from 11.1 billion. Another thing that's a bit worrying is that the annual borrowing is going to equal 15.2% of the UK economy, which would be the highest since World War II end. And they always borrow during world wars, and we've seen that in previous videos that we've done. I might put a card up here. But basically, that is a pretty high number in terms of borrowing equal to the UK economy. On to the second wave news before the technical analysis and other information. It turns out that Wuhan has 200 new cases. So we've got 200 new cases over there. We'll call them asymptomatic cases, but realistically, this just shows that there is a highly contagious, virus out there, and pretty much we have not seen necessarily the end of it. We are seeing a spike in cases in multiple countries. India cases at 150,000, expect them to increase as they start testing and they start finding out it's everywhere. And unfortunately, it looks like it's really heavy in Brazil. So that is incredibly unfortunate. So the chart that most of you are probably here for is this one. Why did I put 47 days in the thumbnail? Well, I did so because this has happened twice before in the last 2 crashes. Remember, they don't call it a bull trap because it's not convincing. They call it a bull trap because it's a trap. So interestingly, last time in 2001 during the crash, the first pullback then turned into effectively a 47-day bull run and made 19% increase from the bottom to the top. During the 2008 crash, which was the second big crash, 47 days from the bottom to the top, this time 24%. Now this one is bigger, but we haven't actually hit 47 days yet. I believe we're around 45 days. I've been making a few videos this week, so check them out, about the timing, about the pullbacks, about all those things. So make sure to watch those to see what I'm talking about. But we are at the 200 SMA, the same as you were back then in both of these cases. And while the percentage increase has gone up, that is basically due to the Fed, due to the stimulus. And on top of that, you've also got incredibly fast markets nowadays. So it'll be very interesting to see whether this statistic holds up. So let's take a look at the technical analysis on the Nasdaq quickly. I've just drawn this quick horizontal line around this 9,300 area, just under 9,300, 9,280. Basically, there was previous resistance, which has now become support. And if the market closes below this zone, expect the market to gravitate towards 9,000 and then potentially find some support on the 9,000 because that will be the 200 SMA. But the Nasdaq is painting a picture of people moving out of some of these tech stocks, potentially putting into value stocks or stocks that are discounted because people are starting to see a potential overvaluation of stocks on the Nasdaq. And this, to me, seems pretty not likely because look at what we've got here. We've got almost a full V shape. We are at critical. We are at the previous resistance. We have the full V shape. I would expect a pullback from this zone. It seems incredibly likely based on so many stats, based on so many other things. But what about the S&P 500? What is it doing? Well, the S&P 500 is weird. At the moment, it's going up pre-market when the US is actually closed, and then it is selling off into the open and then closing lower. So we have the 200 SMA moving average. We have rejections at the 3,000 psychological zone, and we are currently in a bit of a rejection under 3,000 as I shoot this video, 2,999 it looks like. So the S&P 500 futures are trading higher, and then the market is actually hitting them back down, and today will be an incredibly important close. If we close under 3,000, that will just signify the sentiment starting to change because the market's trying, but it's not able to get past. So why could this be? Well, one of the reasons could be that we're starting to see put-call ratio drop a little bit. And that's important. We actually want less people to expect something. When no one expects something, it happens. When people expect it to happen, it never happens. So put-call ratio actually rose at the beginning of May. Now, I have some suspicions on that. I even made a video on this channel. Everybody knows of the concept sell in May and go away. It's becoming less likely that it's even doing it. Statistics, yes, it shows that May is often a weak month and April is actually a very strong month. But it turns out that when everybody seems to think something, it usually doesn't occur. I've got a couple of case studies for that, which I'll cover on this channel. But basically for now, we have put ratios dropping, and I would love them to drop even more. I mean, if they get to 1.1 and sit there, that'd be awesome. 1.2 doesn't matter to me because really then the market isn't expecting something. Notice over here as well, during the 2015, let's call it Greek and China crisis, put-call ratios were getting as high as 3.77. So it shows you that when the Greek debt default was a problem, people were scared. The Greek debt default problem is nothing compared to the current debt that is being put into the market. So in 5 short years, everyone has been conditioned to this idea of never-ending debt, quantitative easing and all sorts of other fiscal policies are okay. And crazy returns each way are okay. So I've been talking about conditioning a little bit, but this used to spook the market. Now it isn't spooking the market. It's very interesting to see how things have changed and expectations have changed. So what about volume? Well, volume has definitely been less over the last week than it was previously. So we are going up with incredibly thin volumes, or at least less volume than you would expect. Here are the weekly volumes. You can see they are less. And remember, volume does definitely count. This isn't the best volume chart, but it certainly counts for something. So I want to now talk about a bit more of a positive story in terms of an opportunity in the market, maybe over the longer term. And that comes from iron ore. Now, I'm in Australia. Many people would know there's a lot of iron ore here in Australia, and we have some of the biggest companies in the world with iron ore. So here is the GFC and what happened. And generally, iron ore will slump coming into a recession and through a recession, but it will often spike heavily coming out of a recession. And that is due to demand in the metal as governments try to create jobs where they're building and they're constructing and they're doing all sorts of things like that. Generally, that is what governments have done. They're building stuff. And I saw an article today, I think Trump wants to build a whole bunch of bridges and roads and all sorts of things. So expect that as economies come out of the recession, whenever that may be, we will get large amounts of construction projects. And that could be an interesting proposition to buy big iron ore companies, which at right now are still trading at a relatively decent discount. So it might not be right now that you want to do it, but it's definitely an idea. And this is the thought process that can go in to investment. We'll cover this more in the channel. So I want to end today's video asking the community a question. Many investors are wanting to see a second bear crash to pick up cheap stock. So I want to ask you, put in the comments down below 3 stocks that you would buy if the market crashed over the next few weeks. If you can't answer that, then I don't think you have a good enough plan. And that can be very dangerous because you need to make decisions when the opportunities arise. So let us know your top 3 picks in the comments down below. And remember, always have a plan for your trading ideas. Because if you have an idea and you don't have a plan, you can never instigate it. If you're enjoying our videos, make sure to subscribe. Of course, hit that bell, give us a like, put some comments down below to help us with the YouTube algorithm and making this channel bigger and supporting us. And also consider coming into our Discord channel with the links below and joining the trading community and sharing your trades and trading ideas with other fellow investors. Thanks everybody, and happy trading.